As a new investor, chances are you started with stocks. Now though, with a little bit more experience, you might want to start branching out and broaden your portfolio. It has long been proven that a diverse portfolio is the best way to minimize risk and maximize profits as an investor. After all, spreading out your assets offers protection against market changes, something that is becoming increasingly important in today's world. So investing in commodities can be an important way to diversify your investments beyond traditional securities. But as a new investor, let's first be clear on exactly what commodities are. Commodities refer to any uniform resources that are considered to be basic goods. From the grains which make up your breakfast cereal to the silver and copper, the crude oil that is refined into the petroleum you use to drive your vehicle, commodities are many things, but what they all have in common is they are physical in nature and traded on the world markets. Commodity prices often fluctuate wildly because of changes in their supply and demand. For example, when there's a big harvest of a certain crop, the price usually goes down. And when there's a drought, prices often rise because of fears that the supply will drop. Commodities that are traded are typically sorted into 4 broad categories: metal, energy, livestock, and meat. Each category has its own upsides and risks, so your choice for which to invest basically depends on your ultimate goals. Commodities can be a risky game if you don't know what you're doing, and it'll be much more profitable long-term to get a grasp on the basics first than to proceed later. There are several ways to invest in commodities, each with unique benefits and risks to consider. So here are 6 ways you can get into commodity trading. Number 1. Invest directly in the commodity. There's no other way to be involved in commodity trading than to directly invest in one of them. If you want to invest by physically buying a commodity, one advantage is that you don't have to go through a third party. You can simply search for a dealer to sell you a particular good, and when you no longer want it, that dealer will often buy it back. But you gotta figure out delivery and storage logistics. Moreover, if you're buying gold, this transaction may be relatively simpler. You can easily find a coin dealer online who can sell you a bar or coin. You can safely store it and later sell it as you wish. But it gets a lot harder when you're trying to figure out the delivery and storage of cattle, crude oil, or bushels of corn. For that reason, investing in most physical commodities typically takes too much effort for individual investors. Number 2. Invest in commodity ETFs. If you have a firm grip on stock investing but have limited capital to invest, then it's best to approach commodities through ETFs. ETFs are exchange-traded funds that allow you to trade commodities in a similar way to stocks and shares. They can be bought and sold similar to stocks, with prices changing throughout the trading day. Investors hoping to purchase commodity ETFs can do so with the help of an online or traditional broker. ETFs are a great option for those who are interested in fluctuating commodity prices, as they can potentially profit from fluctuations in commodity prices without investing directly in futures contracts. Trading ETFs is also a great way to get exposure to the commodities market with less risk, since you can hold your ETF shares for as long as you want and they don't expire after a set period of time. But be aware of some of the fees associated with trading ETFs, or you can simply ask your broker if they offer a demo ETF trading before investing. Number 3. Invest in future contracts. Another way to get into commodity trading is through a futures contract. A futures contract is a legal agreement to buy or sell a particular commodity at a predetermined price at a specified time in the future. Getting started in futures contracts does involve a lot of research on the industry and is typically not recommended for beginner investors. The reason is that a lot of futures investing revolves around speculation. Investors can, however, work with a broker or opt for contracts with an option to buy. With futures contracts, traders bet on how the commodity's price will move. When you think the price will go up, you'd buy futures, and when you think the price will drop, you'd sell futures. In general, you're agreeing to buy X amount of a given commodity at a specific date in the future. For example, you might agree to buy 10 tons of coffee 30 days from the date you place the trade. You are hoping that there is a significant enough difference in price by then so that you'll make a profit. One big risk of trading commodities is that the margin requirements are significantly lower than for stocks. When you trade on margin, you're trading borrowed money, which can amplify your losses. Given how volatile commodity prices can be, it's essential to have enough resources on hand to cover any margin call, which is when your broker requires you to deposit more money. Some of the most popular exchanges for futures include S&P 500 Index, Dow Jones Industrial Average, Nikkei 225, FTSE 100 Index, and DAX Performance Index. Number 4. Invest in commodity stocks. You can also invest in commodities indirectly by investing in the companies which are involved in commodities production. For example, you could buy mining stocks, oil stocks, or agriculture stocks. Investing in British Petroleum is a way to get involved in the oil business, and investing in Rio Tinto is a way to get involved in all manner of metals. The risks associated with commodity stocks typically center around the companies themselves. Prices may be negatively influenced by business operations or other company-related factors as opposed to the just actual value of the commodities. This means a commodity-producing company won't necessarily rise or fall in line with the commodity it produces. Sure, an oil production company will benefit when crude oil prices rise and suffer when they fall. But far more important is how much oil it has in its reserves and whether it has lucrative supply contracts with high-demand purchasers. Unfortunately, there's not a way to reduce this risk completely, but investors can heavily research the companies before purchasing stocks. Number 5. Invest in mutual and index funds. Mutual and index funds are a good option for beginning investors as a step into commodities, as they work differently from other types of commodity investments. These funds have liquidity like stocks, but they don't trade on an exchange. With a mutual fund, you pool your money into a fund with other investors. When investing in commodity mutual funds, you generally have the help of a professional fund manager. Just keep in mind that managed funds tend to come with higher fees. You can invest in multiple commodities and industries with a managed account, which allows for immediate diversification. Index funds, on the other hand, track the price of a specific commodity over a trading day. Because mutual funds don't use an exchange, they don't track the price during the day. They wait until the end of the day after the price is settled to determine the commodity's value. By investing in these funds, you get the benefit of professional money management, added diversification, and liquidity. This makes investing in mutual and index funds a great option for investors hoping to profit from companies that deal with commodities without directly buying stocks themselves. Number 6. Use commodity pools. Commodity pools are a way to combine resources from a group of investors to purchase futures contracts and options. It is best to hire a commodity pool operator or CPO if you don't yet have experience in investing in commodities. These people collect money from multiple investors to pool into one fund and then invest it in a commodity or commodity basket. They will distribute account statements and annual financial reports to the investors involved. Your CPO will not only manage your fund, but also keep records to show who's investing, what they've invested in, and the transactions related to the pool. They may also make investment decisions based on the fluctuations of a particular market. For instance, they can help you track commodity prices and decide which ones work best for your portfolio. Using a CPO also gives you more options when it comes to investing. Because they manage a pool of investors, they can use the pooled funds for better investments, creating more opportunities for trading commodities. Alright guys, these are the 6 ways you can invest in various commodities. Well, commodities are known to be risky investment propositions because they could be affected by uncertainties that are difficult if not possible to predict, such as unusual weather patterns, epidemics, and disasters, both natural and man-made. On the whole, commodities are best suited to investors with a large chunk of capital to spare and at least some experience. It is best to manage risk by making commodities a part of a balanced portfolio, rather than putting all your eggs in one basket. If you're looking to invest in a commodity for the long term, commodity stocks, mutual funds, and ETFs are a better option for most individuals. Let us know what you think about investing in commodities in the comments below. Thank you so much for watching the video. Please leave a thumbs up and share the video if you found it to be useful. For more interesting videos about investing in personal finance, click on our channel and don't forget to subscribe. See you guys in the next one.